Most investors fail not due to poor stock picks, but because they skip the essential preparation needed for long-term success. The first step to building wealth is mastering your circle of competence by truly understanding the business you are buying. Warren Buffett and Peter Lynch emphasize that if you cannot explain a company's revenue model as simply as telling a friend, you are likely gambling rather than investing. This is critical because individual stock picking is a high-stakes, complex financial game. Historical data shows that only a tiny fraction of stocks generate the vast majority of total market returns over time. Furthermore, you must avoid familiarity bias, especially with your own employer, as emotional attachment often blinds investors to objective risks. Once you understand the business, you must evaluate the price using a margin of safety to protect your capital investment. A great company is only a great investment if you pay a fair price relative to its long-term growth potential. This ensures you have enough cushion to survive the inevitable volatility that punishes those who ignore risk-adjusted returns in markets. Step 3 is often overlooked. You must know your financial foundation before you ever put a single dollar into stocks. If you are carrying high-interest credit card debt, investing is like trying to fill a bucket that has a hole. The market returns 8 to 10% on average, but credit card debt often costs you 20 to 30% annually. You must pay off that high-interest debt first, because no investment return can outpace the cost of that financial burden. Next, you need an emergency fund, specifically 3 to 6 months of living expenses tucked away in a safe cash account. Without this cushion, a market downturn could force you to sell your stocks at the worst possible time for cash. The people who build real wealth are not necessarily the smartest, but they are the ones who never have to sell. When the market inevitably drops 30 or 40%, you have two choices: ride it out or lock in your losses. Those who ride out the storm win, while those who panic and sell during the bottom lose everything they built. Consider two investors, both 30 years old, both investing $500 a month into the S&P 500 index fund. Investor A has a solid emergency fund and no credit card debt, providing a stable foundation for their long-term growth. Investor B skips these steps, carrying credit card debt and having no cash reserves, effectively leaving their bucket with holes. Fast forward 5 years, and both have $30,000 in the market when a sudden downturn hits the economy. The market drops 30%, and Investor B loses their job, leaving their portfolio worth only $21,000. With no emergency fund and bills stacking up, Investor B is forced to sell at a massive 30% loss. Investor A, however, faces the same job loss and market crash but relies on their 6 months of cash savings. Because they have that foundation, they keep their investments intact, allowing them to wait for the market to recover. When the market rebounds 18 months later, Investor A is back to where they were and continues to grow wealth. Investor B is left behind, having realized a permanent loss that makes it nearly impossible to catch up to the market. They had the same salary and the same investment amount, yet they experienced completely different outcomes based on one thing. That one thing is whether they built a solid foundation before they ever attempted to build their investment portfolio. Generational wealth is not built by chasing the next hot stock, but by following a disciplined, proven, and boring process. If you skip these foundational steps, you are essentially gambling with your future rather than investing for your long-term success. The market is a machine that transfers wealth from the impatient to the patient, provided you have the right foundation. Never underestimate the power of having cash on hand, as it provides the emotional and financial stability to hold assets. By ensuring your debt is paid and your emergency fund is full, you insulate yourself from the market's worst impulses. This preparation is what separates the casual investor from those who actually build lasting, multi-generational wealth over many decades. It is not about being a genius. It is about being prepared so that you can survive when others are forced. Always remember that your ability to hold through a crash is your greatest competitive advantage in the stock market today. Keep your foundation strong, keep your debt low, and keep your eyes on the long-term horizon for maximum financial growth. The difference between success and failure is often just the willingness to do the simple things that others refuse to. When you have a solid foundation, market volatility becomes an opportunity to buy more, rather than a reason to sell. Most people want the quick win, but the real winners are the ones who build their house on a rock. If you find yourself tempted to skip these steps, remind yourself that the market is not a casino for gamblers. It is a vehicle for wealth, but only for those who respect the rules of the road and stay prepared. Focus on the process, maintain your liquidity, and let the power of compounding work its magic over the long term. Your future self will thank you for the discipline you show today by not cutting corners on your financial foundation. Even in the best of times, you should be preparing for the worst of times by keeping your finances clean. This is the secret that the greatest investors in history have known for decades, yet it remains ignored by most. By following these steps, you are already ahead of the crowd, positioning yourself for a much more secure financial future. Take the time to audit your current situation and ensure your foundation is as strong as your investment strategy requires. There is no shortcut to wealth, but there is a clear path for those willing to do the necessary work. Stay consistent, stay liquid, and stay focused on the long game to ensure your capital continues to grow steadily. The market will always test your resolve, but a strong foundation will ensure you remain standing when others fall away. Building wealth is a marathon, not a sprint, and your preparation is the fuel that keeps you running for years. If you follow these steps, you will find that the market becomes a tool for your success, not a trap. It is time to stop gambling and start investing with the wisdom and preparation that true wealth builders always use. Your journey to financial independence starts with these foundational steps, so take them seriously and build your future today. Remember, the most successful investors are the ones who are prepared for anything, regardless of what the market does next. Keep these principles at the heart of your strategy, and you will be well on your way to lasting prosperity. Now that you have the foundation, you are ready to move forward with confidence and clarity in your investment journey. Beyond analyzing individual stocks, your personal financial foundation acts as the ultimate determinant of your long-term success in the market. Many new investors rush to buy stocks, ignoring the fact that their personal balance sheet is the most important asset they own. Before you purchase a single share, you must prioritize eliminating high-interest debt and securing a robust emergency fund of cash. If you are carrying credit card debt at 20 or 30% interest, investing is like filling a bucket with a hole. The market returns about 8 to 10% annually, so paying off high-interest debt is essentially a guaranteed return on investment. Once your debt is cleared, you need to build an emergency fund that can cover 3 to 6 months of expenses. This cash reserve acts as a critical buffer zone, protecting you from life's inevitable surprises without touching your long-term investments. Without this foundation, a sudden job loss or medical bill during a market downturn could force you to sell at the bottom. Selling during a market crash is the single most effective way to destroy the power of compounding and ruin your returns. The people who build real wealth in the market are not necessarily the ones with the most skill or the best stock picks. They are the people who never have to sell during a crash because they have prepared for the worst-case scenarios in advance. Consider two different investors. Both start at age 30, and both invest $500 a month into the S&P 500 index. Investor A has a solid financial base, with 6 months of expenses in a high-yield savings account and 0 consumer debt. Investor B skips all of those foundational steps, carrying credit card debt and having no cash reserves for an emergency. Fast forward 5 years, and both investors have managed to accumulate $30,000 in their respective brokerage accounts. Suddenly, the market drops 30%, and Investor B loses their job, leaving them with no income and no savings. Their portfolio is now worth $21,000, and with bills stacking up, they are forced to sell at a loss. They lock in that 30% decline, turning a temporary market dip into a permanent and painful financial reality for their future. Now look at Investor A, who faces the exact same job loss and the exact same 30% market downturn simultaneously. Because they have 6 months of expenses in cash, they do not need to touch their investments to pay their monthly bills. They keep their investments fully intact, allowing them to remain in the market while others are panic selling their positions. When the market eventually recovers 18 months later, Investor A is back to where they were and continues to compound growth. Investor B, however, is still struggling to recover, having lost their principal and the momentum of their long-term investment strategy. Same salary, same investment amounts, and same market conditions, yet they end up with completely different outcomes for their wealth. The difference is based on one thing only: whether they built a solid financial foundation before they started building their portfolio. This is why you must treat your personal finances with the same level of rigor that you apply to analyzing a company. If you are constantly worried about how to pay your rent or credit card bills, you will never have the patience to invest. Investing requires a calm mind, and it is impossible to stay calm when your basic survival is tied to the stock market's volatility. Your emergency fund is not just money in a bank account. It is the psychological insurance policy that allows you to stay invested. It gives you the freedom to ignore the daily noise of the news cycle and focus on the long-term growth of your assets. Many people view savings as a waste of potential returns, but in reality, it is the fuel that powers your long-term success. Without that fuel, your investment engine will eventually stall out the moment you hit a bump in the road of life. The market is designed to test your resolve, and it will drop 30 or 40% several times over your lifetime. You have two choices during those periods. You can either ride out the storm and let it recover, or you can sell. The people who ride it out win, and the people who sell lose, regardless of how good their stock-picking skills are. This is the hidden secret that most financial influencers will never tell you because it is not as exciting as picking stocks. But building wealth is a marathon, not a sprint, and you cannot win a marathon if you fall over at the first mile. By securing your financial house first, you ensure that your investments have the time and stability required to grow over decades. This discipline is what separates true wealth builders from those who perpetually spin their wheels in a cycle of financial instability. It is not about being smarter than the market. It is about being more prepared for the inevitable cycles of the economy. When you have no debt and a healthy emergency fund, you become an investor who can act with logic rather than emotion. You stop looking at the market as a place to get rich quick and start seeing it as a tool for long-term growth. This shift in perspective is the hallmark of a sophisticated investor who understands the true nature of risk and reward. Remember that the most successful investors in history are those who have survived the longest by managing their risks effectively. They know that the biggest risk to their portfolio is not the market itself, but their own potential to make bad decisions. By removing the pressure to sell, you eliminate the biggest risk factor that causes most retail investors to fail completely. It is a simple strategy, but it is one that requires the patience and the discipline to execute correctly every single time. If you find yourself tempted to skip these steps, remind yourself of the cost of being forced to sell during a downturn. The math of percentage losses is brutal, and it takes massive gains just to get back to where you started before. A 50% drop requires a 100% gain just to break even, which is a hole most people never climb out of. Protecting your capital is the first rule of investing, and your financial foundation is the primary tool for that protection. Do not let the excitement of the market distract you from the boring, necessary work of building your personal financial base. It might not feel as rewarding as buying the next hot stock, but it is the prerequisite for all future financial success. Take the time to pay off your debts, save your emergency fund, and build a life that can withstand market volatility. Once you have done that, you will find that investing becomes much easier, more predictable, and significantly more profitable over time. You will be able to sleep soundly at night knowing that your financial future is secure regardless of what the market does. This peace of mind is the ultimate dividend that a solid financial foundation pays to those who are patient enough to build it. The people who build generational wealth are not necessarily the smartest. They are simply the ones who never sell during downturns. By securing your financial house first, you ensure that your investments have the time and stability required to grow over decades. Stay focused on these foundational steps, and you will be miles ahead of the vast majority of investors in the market. Understanding your time horizon is the most critical foundation for successful investing, as mixing short-term needs with long-term goals is the primary cause of portfolio failure. Money required within 5 years belongs in safe vehicles like savings accounts or treasury bills, while stocks are reserved for long-term wealth building. In these long-term accounts, you can ride out inevitable market volatility, as history shows the market recovers from every crash for those who remain patient. The stock market has crashed 19 times in the last century and a half, yet every single time it recovered to reach new, higher peaks. This recovery only benefits you if your timeline is long enough to ride out the storm, which is why your asset allocation must match your needs. Money needed in 1 to 3 years should stay in cash or equivalents, while money for 3 to 5 years needs a conservative, balanced approach. Once you cross the 5-year threshold, you can begin increasing stock exposure, but true wealth building belongs to the 10-year-plus horizon. This is your retirement money and your generational wealth, which requires the patience to ignore the daily noise of the financial news cycle. Most people fail because they put short-term money into individual stocks, hoping for a quick gain, only to panic when the market inevitably dips. Mixing short-term liquidity needs with long-term investment goals has ruined more portfolios than any single bad stock pick ever could in history. As Warren Buffett famously noted, the stock market is simply a device for transferring money from the impatient to the patient investor. Even if you are starting in your 40s or 50s, it is not too late to build significant wealth through consistent, long-term market participation. The math is undeniable. If you invested $10,000 in the year 2000 and held through the dot-com crash, you would be well ahead today. Panic selling at the bottom is the ultimate wealth destroyer, proving that your outcome depends more on your discipline than on the market itself. We must also consider the sequence of returns risk, which explains why the timing of market swings matters immensely when you first enter retirement. Two people with identical portfolios can have vastly different outcomes if one retires into a bear market and the other into a bull market. If you are forced to sell shares to cover living expenses during a market downturn, you deplete your capital base when it is most vulnerable. This leaves fewer shares to participate in the eventual recovery, which permanently stunts the compounding effect that sustains your lifestyle for the long term. The closer you get to needing your money, the less risk you should take, ensuring your foundation remains solid regardless of market conditions. Now, we must address the fifth step: protecting yourself from your own emotions, which is the factor that truly separates successful investors from the rest. Fidelity research once revealed that the best-performing accounts belonged to people who had essentially forgotten they even owned an investment account. Doing less often beats the urge to constantly trade, because your emotions are the single biggest destroyer of wealth in the stock market. They show up in predictable patterns, such as overconfidence, where you mistake a lucky streak for genuine skill in picking winning stocks. Then there is the endowment effect, where you irrationally value a stock more simply because you own it, blinding you to its actual performance. FOMO, or the fear of missing out, often drives investors to buy at the top after hearing about a stock that already surged. This is the most common way people lose money, chasing past performance instead of sticking to a disciplined, long-term investment plan. Overtrading is another trap, where boredom or a reaction to a news headline leads you to make moves that deviate from your strategy. Consider the story of a trader who made money every morning, only to lose it by lunch because he could not stop his impulses. His solution was a simple kitchen timer that forced him to leave his desk, proving that discipline is about designing your environment. You do not need to white-knuckle your emotions. You simply need to build systems that prevent your impulses from hurting your financial future. The 24-hour rule is a powerful tool. If you feel an urge to trade outside your plan, wait one full day before acting. This simple delay will save you from the vast majority of emotional trades that are driven by temporary market noise or panic. Implement a position size rule, ensuring you never put more than 5% of your portfolio into any single volatile stock pick. Turn off financial news notifications on your phone to maintain your focus on long-term goals rather than the hourly fluctuations of the market. Use an automation system to set up recurring contributions, making the decision to invest automatic regardless of whether the market is up or down. By tying these 5 steps together, you create a robust framework that covers business understanding, fair pricing, and a solid financial foundation. You must know what you own, pay a fair price with a margin of safety, and keep your personal house in order first. Match your money to the right time horizon and use systems to protect yourself from the emotional pitfalls that sabotage most retail investors. This is the same framework Warren Buffett used to build his fortune, and it is the method Peter Lynch used for decades. They are not doing anything you cannot do. They are simply applying these principles consistently over a very long period of time. Now, consider an honest question. Would you rather do all this research yourself, including reading annual reports and analyzing valuations every week? Or would you prefer a tool that has already done the heavy lifting for you, providing clear insights into which stocks to buy? If you prefer the latter, there are professional stock research services that specialize in exactly the framework we have discussed here today. They analyze businesses, evaluate prices, and provide specific stock picks every month with full transparency regarding their reasoning and past performance. These services often cost less per day than a cup of coffee, offering a way to access professional-grade analysis for your own portfolio. The one I personally use and recommend is linked in the description below, so check it out to see if it fits your needs. Remember that this is not financial advice, but rather an educational guide to help you build your own path toward long-term wealth. The journey to financial independence is not about finding a secret shortcut, but about mastering the fundamentals of patience and discipline. Every dollar you invest today is a seed for your future, provided you give it the time and the environment it needs to grow. Stay focused on your goals, ignore the daily headlines, and trust the process that has created wealth for generations of successful investors. Your time horizon is your greatest asset, so protect it by aligning your investments with your life stages and your long-term objectives. Do not let the fear of a temporary market dip convince you to abandon a strategy that is designed to last for decades. True wealth is built in the quiet moments of consistency, not in the loud moments of market excitement or panic-driven trading. By automating your contributions, you remove the emotional weight of decision-making and ensure that you are always participating in market growth. Keep your financial foundation strong, maintain your margin of safety, and always be wary of the influence of your own emotional biases. The market will always have its ups and downs, but your discipline is the one variable you can control to ensure success. Take the time to learn these principles, apply them to your own situation, and watch how your financial future begins to transform. Thank you for joining me on this deep dive into the core pillars of investing, and I wish you the best in your journey. Remember to check the link in the description for more resources, and keep building your knowledge to secure your long-term financial freedom. Stay disciplined, stay patient, and keep your eyes on the horizon, because that is where the real wealth is ultimately found. Protecting yourself from your own emotions is the final, essential step to building lasting wealth, as human psychology is often the greatest destroyer of investment returns. It is the one factor that nobody talks about enough, yet it is the primary separator between those who build real wealth and everyone else. Fidelity once conducted a study on account performance, and the results were surprising. The top performers were people who had essentially forgotten they owned an account. This proves that doing less often beats the urge to constantly trade, as your emotions are the single biggest destroyer of value in the market. These emotions show up in predictable ways, starting with overconfidence, where winning a few trades makes you believe you have developed a special skill. In reality, that success is rarely skill, but it leads to the endowment effect, where you value a stock you own more than it actually deserves. Then there is the fear of missing out, or FOMO, which triggers when you hear about a stock that just soared 200% in value. You buy in at the absolute top, only to watch the price drop, which remains the single most common way that individual investors lose their money. Finally, there is the trap of overtrading, where you have a solid plan but get bored, see a headline, and make a trade that ruins your strategy. There is a famous story about a trader who made thousands every morning, only to give it all back by lunchtime because he could not stop. His solution was not more analysis or better charts, but a simple wind-up kitchen alarm clock that forced him to leave his desk at 10:30. That physical break was enough to disrupt the emotional pattern, proving that discipline is not about white-knuckling your feelings through sheer force of will. True discipline is about designing your environment so that your emotions simply cannot hurt you, creating systems that act as a buffer against yourself. Consider the 24-hour rule. If you feel an urgent need to buy or sell outside your normal plan, you must wait exactly one full day. This one rule alone is powerful enough to save you from 90% of emotional trades that would otherwise destroy your long-term portfolio growth. Next, implement a strict position size rule, ensuring that you never put more than 5% of your total portfolio into any single stock. You should also adopt a news blackout, which means turning off all financial news notifications on your phone to prevent unnecessary panic or excitement. The most effective system is automation, where you set up contributions to happen on the same day every single month, regardless of market conditions. By deciding the amount in advance, you remove the choice from the moment, ensuring your money is invested whether the market is up or down. Let us tie all 5 of these steps together to see the full framework. Understand the business, evaluate the price, and know your foundation. Combine these with understanding your time horizon to match your money to the right timeline. And finally, protect yourself from your own emotional impulses. This is the exact same framework that Warren Buffett used to build his $100 billion fortune over the course of several decades of consistent work. It is also the same proven framework that Peter Lynch used to generate 29% annual returns during his time managing the Magellan Fund. These legends are not doing anything that you cannot do yourself. They are simply applying these principles consistently for years and decades on end. Now, let me ask you something honest. Would you rather do all 5 of these steps yourself, including reading reports and analyzing valuations every week? Or would you rather have a tool that has already done all of that heavy lifting for you and simply tells you which stocks to buy? If you prefer the second option, there are professional stock research services that do exactly what I have walked you through in this series. They analyze the business, they evaluate the price, and they provide specific stock picks every month with full explanations of why they are buying. Their track records are entirely public, their reasoning is transparent, and they often cost less per day than a single cup of coffee. The one I personally use and recommend is linked in the description below, so check it out and see if it is right for you. To summarize, the path to wealth is not about finding a secret shortcut, but about mastering the fundamentals of business and your own psychology. When you know what you own, you can hold through the volatility, knowing that the underlying value of the business remains intact despite price swings. Your financial foundation acts as a safety net, ensuring that you never have to sell your long-term investments just to cover a short-term emergency. Matching your time horizon to your goals allows you to ride out the inevitable market cycles, turning time into your greatest asset for compounding. Protecting yourself from your emotions ensures that you do not sabotage your own success by reacting to the noise of the daily news cycle. It is a simple, repeatable process that has stood the test of time, yet most people ignore it in favor of chasing quick, speculative gains. Remember that the stock market is a device for transferring money from the impatient to the patient, and your patience is your competitive advantage. If you start today, even if you feel like you are starting late, the power of compounding will work in your favor over the next 20 years. The math is undeniable, and the history of the market shows that those who stay the course are the ones who ultimately reach their goals. Do not let the fear of a market crash stop you from starting, because every crash in history has eventually been followed by new highs. Your biggest risk is not the market itself, but the possibility that you might give up before the magic of compounding has time to work. Stay disciplined. Keep your costs low, and focus on the long-term value of the companies you own rather than the ticker symbols on your screen. The world of investing can seem complex, but when you strip away the noise, it really comes down to these 5 core pillars of success. By following this framework, you are not just buying stocks. You are becoming a part owner of businesses that generate real value for the world. This is how generational wealth is built, not through luck or timing the market, but through consistent, rational, and long-term capital allocation. Take the time to audit your current portfolio against these 5 steps and see where you might be taking unnecessary risks or emotional shortcuts. If you find that your portfolio is not aligned with your time horizon, make the necessary adjustments today rather than waiting for the next market dip. If you find that you are overtrading, implement the systems we discussed to protect yourself from your own impulses and keep your strategy on track. The goal is to make your investing life as boring as possible, because boring investing is usually the kind that leads to the best returns. As you continue your journey, keep learning, keep reading, and keep refining your process based on the principles that have worked for decades. There is no substitute for the experience you gain by staying in the market and observing how businesses grow and evolve over many years. You have the tools and the knowledge now. The only thing left is to take the first step and commit to the long-term process. Whether you choose to do this research yourself or use a service to assist you, the principles remain the same, and the outcome is up to you. Thank you for joining me on this deep dive into the mechanics of building wealth, and I hope this framework serves you well for years. Remember that this content is for educational purposes only and does not constitute financial advice, so always do your own due diligence before investing. Take control of your financial future by applying these lessons, and you will be well on your way to achieving your long-term financial goals. The journey of 1,000 miles begins with a single step, and your first step is to get your financial house in order today. Stay focused, stay patient, and keep your eyes on the horizon, because that is where the true rewards of long-term investing are waiting for you. I look forward to seeing you succeed as you build your portfolio and secure the future that you and your family truly deserve. Keep these 5 steps in mind, stay disciplined, and let the power of compounding do the heavy lifting for you over the coming decades.
If this clicked for you, share it with someone who needs to hear it and subscribe. Every week, I break down exactly how the market works in plain language, no fluff, no noise, just the stuff that actually matters for your money. I will see you in the next one.